A strange thing is happening in the world's richest societies. A generation that owns the most property, the most stocks, and the biggest pensions is aging out. And as they do, trillions will move through inheritance. This is called the Great Wealth Transfer. But here is the uncomfortable truth. This isn't a story about money moving evenly across society. It's a story about who already owns the compounding assets and who doesn't. The biggest wealth handover in modern history, and why it is quietly rebuilding a world that looks less like meritocracy and more like dynasty. What does wealth transfer mean? Assets moving from one person to another, usually from older generations to younger ones. Houses, land, shares, businesses, pensions, trusts. What is the $70 trillion transfer? The most widely cited public estimate on the full scale is from Cerulli Associates, a wealth research firm that tracks this using demographic and wealth data. Cerulli's projection says $124 trillion is expected to transfer through 2048. About $105 trillion is expected to go to heirs, about $18 trillion is expected to go to charity, and nearly $100 trillion of the transfers are expected to come from baby boomers and older, which Cerulli estimates as roughly 81% of total transfers. A massive share of the wave is being generated by a tiny slice of very wealthy families. That's the key frame. Who holds this wealth today? The key cohorts: silent generation, roughly born 1928 to 1945. Baby boomers, roughly born 1946-1964. These cohorts lived through post-war reconstruction, long expansions in jobs, housing, and credit access, and decades where property and equity markets rose over time. But here's the point: must understand, they didn't just work in that era. They owned during that era. Owning during a long asset boom is fundamentally different from earning wages during a long asset boom. Because wages help you live, assets help you multiply. The US concentration example: hard data. One clean way to see why inheritance won't be even is to look at who owns wealth right now. A standard public series used by economists and journalists based on Federal Reserve distributional measures and published through Fred shows the top 1% held about 31% of US net worth. That one number tells you the shape of inheritance. Who is the top 1% in the US? Number 1, ultra-high net worth families. These are households with tens or hundreds of millions in net worth. Number 2, founders and major shareholders, tech founders, finance and hedge fund principals, private equity partners, owners of large private businesses. Number 3, heirs of established wealth. This group is often invisible, not run companies, not appear in media, live quietly. But they control trust funds, inherited property, long-standing investment portfolios. Number 4, high-income professionals, senior doctors, corporate executives, top lawyers. But here's the key truth: high income alone does not put someone in the top 1% of wealth. Many high earners, arrived late to asset ownership, carry debt, depend on continued work. They are a minor share of the 1%. The UK generational property concentration, hard data. In the UK, housing wealth is heavily concentrated among older homeowners. Estimates from Savills show that owner-occupiers aged 60 and over now hold around 56% of all owner-occupied housing wealth. Within that group, those aged 75 and above alone account for nearly 23%. By contrast, homeowners under the age of 35 collectively hold only about 6% of total housing wealth. This reflects decades of rising property values, not differences in effort, and helps explain why inheritance rather than income is becoming central to future wealth outcomes. At a global level, a major theme in wealth reporting is that the US and China together represent a very large share of global household wealth, meaning the wealth transfer story is disproportionately shaped by what happens in those two systems. Why did boomers accumulate so much? People ask, did boomers simply work harder? That's not the main story. The main story is timing plus structure plus access to assets. 1. Economic tailwinds, post-war expansion. Boomers entered adulthood in decades where, across much of the developed world, economic growth was strong for long periods. Stable employment was more common in many sectors than it is now. And crucially, the big appreciating assets, property and equities, were far cheaper relative to incomes than in later decades. This matters because the biggest wealth engine is not effort alone, it is entering the ownership system early. 2. Housing, the biggest wealth engine for the middle class. For most ordinary families, the home is the wealth machine. Because a mortgage does something psychologically invisible. You make payments. Inflation slowly reduces the real weight of those payments, and if prices rise over decades, you gradually build equity. Even families who were never rich can become asset-rich through this. OECD and other long-run studies consistently show wealth concentration rises when home ownership and asset values rise unevenly. And UK discussion around house price to earnings ratios has remained a major public concern for years. 3. Pensions and retirement accounts. Boomers also benefited from retirement structures that often had more widespread employer pension coverage than younger cohorts experience today. Varies by country, but the generational difference is widely documented. And in many cases, stronger employer risk sharing through defined benefit arrangements. But even where systems shifted to individual accounts, boomers had the advantage no one can buy: time. 4. The compounding advantage, assets versus wages. Here's the simplest truth that explains almost everything. Assets can compound faster than wages grow. So if you own assets early, time works for you. If you don't, time works against you. What is wealth made of? When we say wealth, what is it actually made of? In developed economies, household wealth is heavily concentrated in housing equity, retirement pension wealth, mutual funds, private business ownership. The OECD provides cross-country wealth distribution measurement and repeatedly highlights how wealth is far more concentrated than income, especially in asset-heavy societies. Now here's the key idea for common people. If a society's wealth is mainly in assets that grow automatically, property, stocks, pensions, then wealth transfer becomes a transfer of compounding machines, not merely money. That means inheritance is not only support, it is the transfer of a long-term advantage engine. Why this is invisible? People sometimes ask, is this planned? Mostly no, it is structural. Here's how the system builds itself invisibly. 1. Post-war mass asset building, middle-class expansion. After World War II, many governments promoted home ownership, pension participation, education access, and broader participation in the formal economy. This created genuine upward mobility for many. But it also created a society where wealth became tied to asset ownership more than income. 2. Financialization plus asset inflation. Over time, property became an investment vehicle, not just shelter. Equities became central to retirement outcomes, and long stretches of asset appreciation created wide gaps between owners and non-owners. So if you already had assets, you benefited automatically. 3. Policy design often favors capital durability. Many systems include mechanisms that help wealth last: tax-advantaged retirement structures, trust frameworks, estate planning tools, and rules that can make large asset pools easier to preserve than small ones. We don't need to claim one global conspiracy. 4. Unequal access to ownership. Access to ownership was never equal. Credit access differed, family support differed, home ownership timing differed, investment participation differed. So the compounding machine started earlier for some families, and much later, or never, for others. This is why the Great Transfer isn't just boomers giving money. It's decades of compounding being handed to the next generation. The big history behind the system. How did we go from feudal kings to democracies, but still end up with inherited advantage? Here is the factual historical mechanism and why it's unseen. Step 1. Feudal power was land plus force. In feudal systems, wealth was tied to land ownership, extraction rights, inheritance by blood. Explicit hierarchy. Power was visible. Step 2. Revolutions and reforms changed politics faster than property. When monarchies weakened and democratic institutions expanded, political authority shifted faster than economic ownership patterns. In many places, property systems weren't wiped clean. Instead, old wealth often converted forms. Land holdings became modern real estate holdings. Titles mattered less, but ownership mattered more. This is why the shift is unseen. Democracy changes who votes. It does not automatically change who owns. Step 3. Industrial capitalism created new dynasties. The 1800s and early 1900s created modern wealth engines: railways, steel, banking, oil, manufacturing, and most importantly, shares. Shares created a new type of inheritance: ownership of a cash-generating engine. Point 4. The welfare state created a middle-class asset base, but not equal capital power. Post-war democracy helped millions build assets. But because the top already owned more, the top also captured more of the asset boom. So equality improved for many, but concentration remained. Point 5. Modern finance locked in compounding advantage. As property and equities became the main wealth engines, societies began producing two lanes: a lane where wealth comes from wages, a lane where wealth comes from ownership. Inheritance is the bridge that keeps the ownership lane inside families. That's dynasty without monarchy. What about systems that are not Western democracies? China. Wealth transfer in a property-heavy society. China's household wealth has been widely reported as heavily concentrated in real estate, meaning the inheritance story is strongly linked to property values and housing cycles. That creates a different inheritance risk profile. If property values rise for decades, inheritance reinforces wealth. If property stagnates or falls, heirs may inherit assets that don't compound the way prior generations assumed. So China can experience not only wealth transfer, but risk transfer. Russia. State assets, private dynasties. Russia's modern wealth concentration story is heavily shaped by the post-Soviet era, when major assets and sectors moved from state structures into private ownership networks. This creates a model where dynastic wealth can be built quickly once ownership is consolidated, and then preserved through family succession, influence, and asset control. So Russia is less feudal inheritance continuing. Gulf, Arab region, elite continuity plus state-linked capital. In several Middle East contexts, wealth continuity often blends family wealth, elite networks, and state-linked capital structures. World inequality. Lab research argues the Middle East is among the most unequal regions, with very high shares going to top groups. Will the great wealth transfer transform markets? Now we answer the investor question. Market impact depends on two things. One, who receives the wealth. If most wealth is concentrated at the top, then much of what transfers remains within households already participating in capital markets. Two, how heirs behave differently from donors. Public wealth management research suggests that heirs often behave differently from donors. Younger generations tend to diversify away from traditional portfolios, showing greater interest in private markets, alternative assets, and new investment structures. This is not ideology. It is generational behavior observed across global capital markets. The future impact. Let's talk about what this does to the next 20 years, using the strongest evidence-based themes. 1. Housing becomes even more inheritance dependent. In the UK, the wealth split in housing is already very large across age groups. If deposits are the gatekeeper, inheritance becomes the admission ticket. This can produce two parallel societies, early owners with family help and long-term renters without it. 2. Inequality becomes more structural and less temporary. OECD wealth distribution analysis shows how concentrated wealth is compared to income. That matters because wealth reproduces itself more easily than wages do. 3. The political economy becomes more locked. As more families rely on inherited help to enter housing, policy debates become more sensitive. Inheritance taxation. Property taxation, capital gains rules, planning and housing supply. Even without corruption, concentrated wealth tends to shape what is politically realistic. 4. Social trust and legitimacy get tested. When people experience a world where hard work doesn't reliably translate into stability, because the entry gates are asset-based, trust erodes. 5. The psychological split deepens. Security versus fragility. Inheritance doesn't just buy things, it buys stability, the ability to fail and recover, the ability to move, the ability to take risks, the ability to say no to bad jobs. This is why inheritance becomes a social class engine, not just a financial event. Thank you for watching. If this inspired you, hit subscribe, like, comment and share. Be part of our journey. Beyond identities, beyond borders, beyond divisions, our destiny is one. You are watching Next Horizon Global.